Good afternoon and welcome to our weekly livestock market update. I'm Brownfield news anchor reporter Meghan Grebner. With us is University of Missouri livestock market analyst Scott Brown. Good afternoon, Scott.
Good afternoon, Megan.
Let's start first. It is the first week of 2017. So first of all, Happy New Year.
Happy New Year, yes.
As we look at this week in the livestock market, where did things end up? How did we kick off this new year?
Yeah, so it has been a fairly quiet week. We've been sideways for the most part. You know, we had an official holiday on the 2nd. So it's been a short week for markets, again, as we kind of wrap up the holiday season, if you will. And so we've been fairly sideways. If you look at hog prices for the week, they've been fairly flat. We have been, depending on whether it's feeder cattle or fed cattle, futures for them have been down 350 to 450 for the week. So a little bit of weakness there. Cash cattle prices a little around across the board, of some up, some down, but it's been a fairly flat week. When you look at where we are on the wholesale side, we were up about $1 on choice beef relative to a week ago. Pork cutout was down about $2 relative to a week ago. So again, a fairly flat week as we enter 2017.
As we look ahead, we talked about the hogs and pigs report that we saw in recent weeks. We talked about the amount of cattle on feed, and one of our constant themes is a demand, and we need to look at demand. As we look ahead to 2017, we saw the jobs report come out today. Have we maybe hit our peak when it comes to demand for our goods here?
Well, it makes you wonder when you see some of the current data that we're beginning to see on the demand side. You know, out of that jobs report today, we got 156,000 jobs added. So we did get jobs added out of that last report. It just didn't quite meet pre-report expectations that were closer to 180,000 jobs. So I do worry a little bit about the momentum that we've seen really since early November is going to be difficult for us to continue to see moving forward. If you look at things like the Dow Jones Industrial Average setting pretty close to 20,000 yet again. So a lot of signs that maybe much of the strength we've seen on the demand side, at least from the general economy side, might be starting to slow down. We did get news from the Restaurant Performance Index this week. It gained a mere 0.2%. So it seems to me when you look at the same stores traffic being reported there that we're a lot more anemic in terms of growth in restaurant sales that might suggest as well things are starting to slow down just a little bit.
What are some of the other things that we're looking at when it comes to the demand side of things? Are we watching the strength in the U.S. dollar or the price of crude and how maybe they impact the market as well?
Yeah, absolutely. So, you know, the dollar continues to strengthen of late, and it's amazing what's been some fairly strong export demand strength even in the face of that strengthening dollar. But that's going to continue to weigh on our ability to export meat products out of the United States. And as you and I have discussed several times, we have a lot of meat still coming to the marketplace in 2017. And when you look at things like the hogs and pigs report, it's only growing in terms of that supply of meat, and certainly moving it internationally is important. So if the dollar keeps strengthening, you know, that's a little bit worrisome. Interest rates starting to show a little more interest to increase, I guess, as we look ahead, and I think that affects both sides of the equation. Number one, you know, those that are borrowing money to produce hogs or cattle, that money's going to cost them more than it did a few months ago. As well, from a consumer standpoint, any of those folks that might be looking to or on adjustable rate mortgages or looking to refinance, those opportunities may be gone for a period of time, and they're going to see higher interest rates as well. And oil prices keep going up. We've come up $15–20 a barrel from the low that we would have seen in 2016 in terms of crude oil prices, which in some ways just makes that consumer dollar have to maybe be moved away from meat products towards crude oil and gasoline consumption.
As we look ahead to 2017, Scott, we talk a lot about concerns about prices for our livestock and what could happen. But we also probably should talk about the other side of that and inputs and maybe some volatility that we're going to see potentially in the row crop commodities. What are we watching for when it comes to feed prices for this year?
Yeah, so I really think we can look at a time step as we go. And number one, South America crops matter a lot as we look ahead. I think we saw a little bit of bump in feed prices as some were worried about the weather situation in South America. I think that's changed a lot, and we're continuing to now talk about better crops in South America that I think has kept feed costs in better stead for us the last few weeks. But that's going to be, I believe, the market mover for a large part of the next several weeks that we have. But it won't be long before we're going to get in that big acreage discussion going on in the United States about corn versus soybean acres. When you look at those relative soybean prices and corn prices, we hear a lot of folks who are going to say we're going to plant a lot of more soybeans this year relative to corn. And that debate, I think, is going to continue all the way until we get the June acreage report out of USDA and see what we finally put in the ground. Because you can hear the flip side of that as well. A lot of producers who will say, I don't want to change rotation very much, chasing what might be higher soybean relative to corn prices. So we'll see about that acreage, but that's really coming up next. And again, I'll remind us, it wasn't that long ago in June of 2016 where we got dry here in many parts of crop regions. And that's when we saw corn at, I believe, on the board at 440 for a period of time. That same thing could still happen as we look in 2017. So we have to be prepared. What have been very nice feed prices, that you don't want to be caught short in what might be a summer in this country that we start to have dry weather.
We talked before briefly about the fact that when you look at cost of production for row crop producers, you look at you look at your cost per acre. When we look at figuring out and understanding where our bottom line is for livestock producers, what are some ways that they can figure out their cost of production relative and maybe to keep it a little bit smaller so they can look at a big picture and maximize every area possible?
Yeah, well, when I think about cow-calf producers in particular, I try to get them to really focus on what's it cost you dollars per cow, start to finish, to get through a year, and how does that compare? And you raise a very good point. I was looking at some USDA data that maybe is a little dated, but it's the most current that we have, that would suggest there's about a $400 range in the average cost per cow across all operations in this country. That's huge. When you think about some folks are sitting there around $600 a cow in operating costs plus capital costs, and you got others that are much closer to $1,000 a cow. Those that are at the low end of that spectrum are the ones that are going to be in business. So thinking about your individual inputs and that dollars per cow discussion, I think, is important. And we really need to start comparing ourselves to others in the country. And sometimes I'll say others in the world. And I don't think we do as good a job of that in the cattle industry as we do in row crops. It's much easier, I guess, for folks to think about dollars per acre when they look at those input side, but focusing on dollars per cow and starting to benchmark yourself against other producers is going to be really critical in what I think is going to be a lower price environment for the next couple of years.
Scott, really, it's been a short trading week with a holiday on Monday, and really things are starting just to pick up in the new year. As we look ahead to the end of the month, we talked briefly about the cattle inventory. We're ahead of pre-report estimates. When we look at that report, why is it so significant for cattle producers in this country to pay attention to what those numbers come out at the end of the month?
Yeah, so, well, first of all, I remind us that we did not get a mid-year inventory report in 2016 because of budget cuts from NASS and USDA on that front. So we haven't seen anything since January 1 of 2016, and we really need to get a good handle. So that's going to come with that count that we get at the end of the month. But I just remind us, so up about 1 million head January 1 of 2016 in terms of beef cows. You know, I've heard a lot of folks who will go, I think we're going to be down in beef cows January 1 of 2017. And they'll point to additional beef cow slaughter. And yes, we did have additional beef cow slaughter in 2016 to the tune of about 330,000 more head of beef cows that went to market in 2016. But when you think about the million head growth we got in beef cows, those cows are going to be with us for a while. We can talk about wiping away 330,000 because of beef cow slaughter. That still means we're likely up when we look at the end of this month in the report that we get out. And the other factor really comes down to how many heifers did we add. I hear a lot of heifer retention that went on. I don't think it got turned off immediately. So I worry we're going to get perhaps a larger count than many are anticipating going into this. So yes, we have put more heifers in the feed yard. That data is helpful to us, but when you look at that percentage, it still is small relative to historical standards. So I don't think we should be walking into this cattle report at the end of the month going, our supply situation is rectified in the cattle industry. I just don't think producers move that quickly. And I'll just add, weather by and large, with the exception of the southeast part of the U.S., has been really good in 2016. Normally when we have good weather, we have lots of hay and lots of pasture, and we have producers trying to take advantage of that by holding on to more cows than they might otherwise. So a lot of things that I see lining up to give us more cows in this report, not less.
It'll be interesting to see where we end up in pre-report estimates, as well as the actual report coming out at the end of the month.
Absolutely.
Scott, anything else this week?
I think we've covered, much of what's there. Unfortunately, we kind of continue down this same story of a lot of production growth coming, and we need strong demand both in this country and around the world if we're going to continue to keep prices at reasonable levels. And I will continue to say I worry about the downside risks that we see in prices in 2017. Maybe not the same kind of slides that we saw in 2016, but perhaps still more pressure coming.
If you have questions for Scott, you can ask them at our website, brownfieldagnews.com. There's a link. You can also subscribe to have our weekly livestock market update delivered directly to your inbox every Saturday morning. Good to see you, Scott. We will talk to you next Friday.
Great to see you as well, Megan.
I'm Megan Grebner on Brownfield.